bigger picture here, then, you're talking about conditions remaining good in the vast majority of international markets. What's new? What's new with you?
I think really we're back to every quarter I come on here, the conditions are more uniform and better across Europe. And partly this is Europe catching up with the rest of the world. We talked about before, they didn't just have the Lehman's crash, they had the Euro crisis. But the last 2 to 3 years now, very strong growth. And the big shift, I think most multinational companies now are looking to invest more in Europe. So we've now gone out of what I classify as the maintenance investment into real incremental investments across all European countries. We had 13 European countries grown by more than 10%, and Germany, which is our largest global business, up 15%. So as strong and uniform conditions that I've seen in Europe since 2006 and 2007.
Well, let's bring it back here to the UK as well. The UK and the city, give us an update there, because, of course, we've just spent the past hour with Jim McCaughan and we're talking about the propensity for a harder Brexit, Hammond's warning. The tone seems to have changed politically as we go to the close of round 5. Has there been any shift from the employers because of the Brexit discussion?
Look, I think everything coming out of Brexit is so inconsistent and so jumbled that most businesses are just getting on with their own plans. So I think there's 2 specific issues. There's the financial services City of London and there's everything else in the UK. Everything else in the UK is concerned, they are cautious, and we've talked before, it's very tight cost control. I think we're actually quite happy with these set of results for the UK and Ireland to be up 1%. And we're happy in the City of London to be flat. It doesn't mean it's a strong market. What it does mean is most companies now are playing the plan. So in the financial service industry, they've already set the structures up. That was what was happening a year ago. Setting the corporate structures up across Europe, they're now clearly starting to make some decisions about where incremental jobs are being placed. And unfortunately, those incremental jobs are not being placed in the UK.
Yeah, so where are they going to? What's your experience of where these financial services jobs are going, to Dublin, to Frankfurt, to Paris? And to what extent will London be a shadow of its current self in, say, 5 years' time, based on what you're seeing about where these jobs are going?
I do not believe London will be a shadow. There's so many advantages from London. We're not talking about the whole pie going, but in the end, we might well find that we've got 10 or 20% having gone, and that might be quite painful. What we are seeing so far is probably Frankfurt and Dublin being the greater winners. But again, it's round the edges. These are not large, they're not job cuts in the UK. It's just if we've got an incremental 20 or 30 or 50 jobs, we're placing them there. But now one of the difficulties we've got is we're 18 months away from the exit point. We're unclear whether we're going to have a transitional agreement. The longer that uncertainty lies, the more the push for businesses to actually get on and do things. So if there is a clear plan coming out on Brexit, that's excellent. I haven't really seen it yet. And all we're getting really is very inconsistent messages, I think, on a daily basis, which doesn't help business plan, other than plan for the worst, be ready for it, and if you have to move, be ready to move quick.
Can I ask you, we get politicians, they all have their own agenda. When it comes to this transition period, 2 years was the sort of the mooted accepted level that the Brexiteers might accept. What are businesses telling you that they realistically need? Do they need 2 years? Do they need more than 2 years?
Well, fundamentally, you need to know what the end game is. So all the transition does is it buys you a little bit more time to continue with the planning and investments now. So fundamentally, we need the end game. But if that end game is going to be, if the divorce discussions continue and continue and continue, we don't get to trade, we don't get on services, then we need the transition period to buy enough time to get a suitable deal. I'm always an eternal optimist, and the optimist has to be, certainly across all trade, that Europe's in exactly the same boat as us. Nobody's going to want any issues at Dover or planes or anything else.
But that just doesn't seem to come through in the discursives at the moment.
I think that's partly where that transition period will be. This has always been, the concern has always been about the service part, because there's no doubt, as we've seen over the last few years, for a lot of European governments, there's this opportunity to grab back part of the financial service industry that they lost to London in the halcyon period. So I think that's still the concerning area. The transition period enables business not to have to jump too early. But the longer we go along this remaining 18 months with no view on the transition period, you force businesses to just stop investment. And then if you come to the real economy, the other part of it is you're not really seeing much front-end construction. Surprise, surprise, because of the uncertainty.
Let me ask you a little bit about wages, Paul, because many economists scratching their heads who are saying in developed markets where economies are strong, we have very low unemployment and wages not going up, and lots of structural questions being asked about whether things are different this time. What is it for you that's keeping wages suppressed at the moment?
Well, I've only been in work for 35 years. So if I use the 35 years I've been for work, I can't ever remember a period like this where every single company is continuously under margin pressure. You know, in most large corporations around the world, procurement is in its halcyon period. Therefore, if your margins are continuously under pressure, you're always looking for efficiencies in your business. What you then can't do is do a fairly uniform large pay increase. And when you add on top zero inflation, pretty much zero interest rates, on a global basis, very low interest rates.
So what might be good for consumers and shareholders, maybe not good for employees and wages?
Well, you've got a large level of people in work, so we should celebrate that first globally. And that supports a level of earnings level. But most companies are not sitting there thinking, fabulous, this is the best period we've had. Most companies are being very surgical and tactical where they're placing that investment in a context of a good world where there's zero price inflation.
We had the IMF talk about a synchronized level of growth. Just give me your Asia numbers look pretty stellar. Asia Pacific, 25% of your business, 14% growth. Is that your standout, and is that all round?
Now, I think Europe is the one which, because it is so big for us, it's half our business, drives everything else. The big new news over the last 6 to 9 months is Asia, which has gone through a quite difficult period of time, certainly in the banking markets and partly the manufacturing space. We've seen a real uptick in investment and sentiment over the last 6 to 9 months. Places like Hong Kong almost doubled in size versus a year ago.